The S&P 500 is hitting all-time highs, not just in price, but in valuation. We are currently trading at a PE of 22.2 compared to a 30-year average of 17. This is almost the same level we saw during the dot-com bubble in the year 2000. Most of this upside has been powered by just 7 companies, the so-called Magnificent Seven. As you can see in this chart, in which they are represented in green, they have massively outperformed the rest of the S&P 500, represented in black. In this video, I'll break down each of these stocks one by one to see which, if any, are still worth buying today. Let's start with Nvidia, currently the biggest company in the world with a market cap of $4.4 trillion, which over the past 3 years has clearly outperformed the S&P 500, as Nvidia is up 1,400% and the S&P 500 only 83%. Nvidia's revenue has grown massively, especially in the past 2 years, as in 2024 they were doing $60 billion of revenue and now they are currently doing $165 billion in revenue. The same goes with their profit. Net income has massively grown over the past 2 or 3 years and it is currently at $86 billion, and the same with their free cash flow, as it has grown mainly in the past couple of years and it is currently at $72 billion. Then their margins are also amazing, with gross margin being at around 70%, and profit margin has also improved massively in the last couple of years, as it is currently at around 50%, and they used to do between 20 and 30%. So the question becomes, can they keep up with this growth? And according to analysts, the answer is no. As you can see, they have Nvidia growing revenue to $391 billion in 2023. But in terms of revenue growth percentage, it is expected to decrease substantially. And in terms of EPS, they are expected to grow from almost $3 per share this year to $9.10 per share in 2030. And I think it's logical the decrease in growth percentage, because as the company gets larger and larger, it is going to be for them more difficult to grow. And in order to calculate the intrinsic value for Nvidia, I used my DCF model. This tells me what the stock should be worth according to your assumptions about the future of the company. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, according to my low assumptions, Nvidia is worth $59 per share, middle $118 and high $213. And because the stock is currently trading at $183 per share, this means that if my low assumptions occurs, you're going to make a negative 7.4% annual return on your money, middle 2.9%, and high 12.6%. In terms of my assumptions, I assume Nvidia growth revenue between 15 and 25% annually for the next 7 years, that they average a profit margin and free cash flow margin between 25% and 45%, and I assign the PM price to free cash flow at the end of the 7 years of 20, 22, and 24. So it seems like Nvidia is a bit expensive right now. Moreover, they are trading at a PE of 52 and a price to free cash flow of 61. And although I believe Nvidia is one of the best companies in the world and their fundamentals are amazing, I think the company is trading quite expensive, which is why I'm not going to personally invest in Nvidia. Stock number 2 is Microsoft, which has a market cap of $3.8 trillion. And has also outperformed the S&P 500 with returns of almost 120% in the past 3 years compared to the S&P 500 of 83%. Their financials are much more consistent, as revenue has grown consistently from $91 billion to $281 billion in the past 10 years. The same with their profit. Net income has grown consistently from $20 billion to $101 billion currently. And analysts are expecting this consistency to keep going, as they are expected to reach $476 billion in 2029 and $25.50 per share. And regarding the DCF model, Microsoft looks quite expensive, as according to my assumptions, the stock is worth between $254 per share and $472 per share, which means negative 1.6% annual return according to my low assumptions, middle positive 3.55%, and high 8.53%. And Microsoft is trading at a PE of 37 and a price to free cash flow of 53. However, they have a fantastic balance sheet with $94 billion in cash and only $112 billion in debt, which again is nothing for a company that has a market cap of $3.8 trillion. And like Nvidia, I think this is a fantastic company with amazing fundamentals, but the valuation is just too expensive. Stock number 3 is Apple, which has a market cap of $3.8 trillion and compared to the S&P 500 in the past 3 years, has had basically the same results. Apple's revenue has been struggling since 2022, as it has been stuck at around $400 billion. The same with their profit, as net income since 2022 has been stuck at around $99 billion. However, analysts are expecting Apple to get back to growth mode and reach $580 billion in 5 years and reach $14.80 per share. And according to my DCF model, Apple seems quite expensive, as it should be worth between $113 per share and $194 per share. This also means in terms of returns that you would get a negative 3.4% annual return on your money, 1% according to my middle assumptions, and 5.3% according to my high assumptions. But if you want to make your own assumptions, I'm going to leave a link down below to the spreadsheet. It's super simple to use, as I've done all the calculations in the background, so you only need to put your assumptions. And in terms of valuation ratios, they are currently trading at a PE of 38 and a price to free cash flow of 39. So again, it seems like Apple is quite expensive, but they have a fantastic balance sheet like the other two companies, with $132 billion in cash and only $101 billion in debt. And therefore, like Microsoft and like Nvidia, Apple is a fantastic company with great fundamentals. However, it is just too expensive for me right now. Stock number 4 is Google, which currently has a market cap of $3.05 trillion and has also outperformed the S&P 500 with returns of 155% compared to the 83% of the S&P 500, although these gains have come mainly from the last year. Google's growth has been super consistent, with revenue growing from $74 billion 10 years ago to $371 billion currently. The same with their profit, as net income has grown from $16 billion super consistently to $115 billion. And like all the companies we have seen, they have fantastic margins, as they are all in tech, with gross margin being at around 58% and profit margin being at around 31%. And analysts are expecting Google to keep their consistency, as revenue is expected to grow to $611 billion and $17.70 per share in 2029. And according to my DCF model, Google also looks expensive, as it is worth between $159 per share and $272 per share, so it would only be a buy according to my high assumptions. Now, I want to say that I have personally bought Google in the past when it was sub $100 per share. You can check it out on my channel, I've done videos on it. So I think Google is a fantastic company that I want to keep owning, but I don't think it's worth $250 per share. Stock number 5 is Amazon, which has a market cap of $2.4 trillion and has also outperformed the S&P 500 in the past 3 years, although by a very little. Their financials have also been amazing, as revenue has grown from $107 billion super consistently to $670 billion currently. And one thing that Amazon was not doing in the past was being profitable, but they have improved this dramatically, and right now they are currently doing $70 billion in profit. And again, a lot of growth is still expected for Amazon, as revenue is expected to grow at an average of 10% per year, and they are expected to get to $13.58 per share in 2029. And in terms of the DCF model, Amazon also seems a bit expensive, as in my opinion it should be worth between $119 per share and $345 per share. So although it seems less expensive than the other companies, in my opinion, it's still expensive. Stock number 6 is Meta, which has a market cap of $1.9 trillion and has also massively outperformed the S&P 500 in the past 3 years, with returns of 473%. Their financials are also amazing, as revenue has grown super consistently with the exception of 2022, and it is currently at $178 billion. The same with their profit. It has grown massively, especially over the past 2 years, and it is currently at $71 billion. And again, like all the other companies that we have seen, amazing margins, with gross margin being at around 80% and profit margin being at around 40% currently. And analysts are expecting growth to keep going, as they are expected to reach $329 billion and $45.72 per share in 2029. And again, according to the DCF model, the stock seems a bit expensive, as it should be worth between $498 per share and $957 per share, and the stock is currently trading at $765 per share. Moreover, the stock is trading at a PE of 27 and a price to free cash flow of 38. But again, like the other companies, they have a fantastic balance sheet with $47 billion in cash and only $49 billion in debt, so basically no debt. I also have videos on my channel saying I was buying Meta when it was around these prices at around $100 per share, and although I believe Meta is a better company now, I just believe it is too expensive at the moment, and I bought the stock around here because I thought it was cheap. And the last stock is Tesla, which has a market cap of $1.4 trillion and which was actually underperforming the S&P 500 until the last year. And regarding their financials, they have actually struggled the past couple of years, as their revenue has even decreased from $97 billion to $92 billion currently. And the same has happened with their net income. It used to be at around $14 billion and it has decreased to $5 billion. Now this company, out of all the companies, has the worst margins. Why? Because this is not a software company. This is actually a car company. This is why gross margin is at around 17% and profit margin and free cash flow margin are now at around 6%. However, analysts have still Tesla with a lot of growth expected, as they are expected to reach $211 billion and $9.65 per share in 2029. So although they are expected to struggle this year, they are expected to recover nicely. And according to the DCF model, Tesla is the most overpriced, as in my opinion it should be worth between $42 per share and $160 per share. Moreover, they are currently trading at a PE of 258 and a price to free cash flow of 258. And in my opinion, Tesla's fundamentals are struggling and the valuation is the worst. So in my opinion, it would be the worst stock to invest into out of the Magnificent Seven. In conclusion, in my opinion, the Magnificent Seven are clearly overvalued and are in a bubble situation at the moment. When this happens, the returns are gonna be very bad in the upcoming years. As an example, Cisco stock, which was the best company in the world in the year 2000, hasn't reached the same price as it was 25 years ago. I hope you found this video valuable. Let me know what you think about the Magnificent Seven stocks in the comments, and I'll see you in the next one.